There's cyclical inflation and there's monetary inflation. And I think that people are not looking, and the Fed is not adequately looking, at the fact that when there's a lot of debt and you create a lot of debt and money, which of course is a great stimulant, also one man's debts are another man's financial assets. As the debts rise, and there's somebody's financial assets, there's a balancing act that becomes increasingly difficult. And so when we look at what's ahead, we do know how these cycles work. We know that you have a recession to a recession, and on average they've been about 7 years. And they're shorter when you start quicker. And so we're in a cycle where there was a lot of money and credit. I mean, from an investor's point of view, think about how bad that debt is. I'm holding cash. Last year I lost 7% to cash. One would have lost 7% in buying power. And now if you have a 5% inflation and so on, the things are changing. And so because they're changing in that way, inflation psychology is going to change. They don't want to hold the bonds, or they don't want to hold the cash, much less. And so we have an extra risk that they may sell those bonds and that cash. And when they do, then that creates a bigger deficit in funding, because not only do you have to sell the Treasury, what the Treasury has to sell, there has to be enough buying to buy what the sellers are selling. And when that comes up, it puts the central bank in the position of either having interest rates rise a lot, and that shuts things off, or having to come in and fill the gap in a bigger way than it was done before. So as that psychology changes and wages change and all of that, we are on the brink of that happening. So yes, we have a big issue pertaining to inflation. The trade-off, it appears to me, that a high enough interest rate to adequately contain inflation of what we might think is adequate is too high of an interest rate for the markets and the economy. So that the trade-off that the Fed is going to face will be an even greater, more difficult trade-off between inflation and growth. Think about it. The tightening that might be priced into the market might take it to 2%, maybe give or take a bit. 2% interest rate, when you have something that could be a 5% inflation rate and you have the supply-demand imbalance, is something that is really a problem. You're going to have a much higher level of inflation than you will have an interest rate. And when that happens, you're going to have continued losses in buying power, and that's not going to be palatable. I think that the Fed's forecast that it was transitory was obviously wrong. Okay? I think they are misunderstanding things. I think they put too much on the cycle, a normal cycle. Why are real interest rates, since we started, when we started setting inflation index bonds, they were 4% real. Okay, how did they get to minus 1%? Why is the equilibrium in interest rates 500%, 500 basis points lower than it was back then? There's something bigger going on. And that bigger thing that's going on is the accumulation of debt, because that's buying power. That's stored buying power. So everybody's got to believe that that stored buying power is real. Yet if you think about how are you going to get that? Can everybody sell those bonds and actually convert that into purchases? No way. So if you look at history, throughout history, there's this bigger thing that's going on, this bigger debt cycle thing that's going on. And so I think there's not enough attention paid to that. There is going to be, when you're stuck with two trade-offs, too much inflation, or you're stuck with too much economic weakness, then you navigate for the middle, and that means something like stagflation. And so I think we're entering a period of stagflation, and I think the political and the wealth gap issues and so on create a set of circumstances that it's not easy to get out of, because everybody needs more money. And so do you get real money? Taxation is the way to do it normally, but it's taking money away from somebody, whoever it is, becomes controversial. The one easy thing throughout history that's always been done is the printing of money, because nobody even pays much attention to where the wealth is coming from. So what it does is, like, everybody got the check and nobody had money taken away from them. And so it's politically easier, but it devalues. Think about the enormous amount of supposed buying power that's in these bonds or other assets. I want to buy a bond, so I'm going to give a lump sum of money. It'll take me 50 years to get back what I gave, and then I'll begin to earn money after that, because it's a 50-year return in nominal terms. If you do it in real terms, I will never get back my money. I'll continuously lose my money. So that, for a creditor, that for a holder, is a difficult thing. And when you get that swing, that's an important force, I think. Three things going on. You have, first, the financial problem. The coffers are empty, you print more money, that dynamic. And then the emergence of populism of the left and populism of the right, both of that never happened in the developed country until recently. I started to study the populism and how that worked. And then in the study, I studied the French Revolution, the Russian Revolution, the Chinese Revolution or Civil War, the Cuban Civil War, and all of those. And it was that same combination of financial problems and very large wealth gaps that produced this populism of the left and populism of the right together. Populists are people who represent an important segment of the society that are fighters. And they say, I will fight for that. They're not compromisers. And our system is based on compromise. So all the statistics, I follow a lot of statistics, as you know, showed greater and greater movement in that. And so it wasn't surprising, because there was plenty of dots to connect as it was emerging there. And I think if we look ahead, we have to ask ourselves about that issue, because we have, in the cycle, received all this money, and we're almost at the best of where we are, and we're now have that polarity. As the cycle progresses, it becomes riskier, the economic cycle, and there's not going to be the same amount of money. And as you look at the 2022 elections, 2023, 2024, it is conceivable, although it seems inconceivable, that you could have neither side except losing. Can you imagine that? And you're starting to see this type of polarity or civil war, conflict of any form, happening also geographically. People are moving not just because of tax issues. They're moving because of wanting to be around people more like them, different values. They might say, I go to Texas, I go to Florida, I go to Nevada, and I'm leaving California, San Francisco, I'm leaving Chicago, I'm leaving New York for these various reasons. Yes, so I think this polarity is an important issue and will play a role even in how much spending. When you hear the discussions of, we need to spend money on this and we need to spend money on that, there's not much talk about where does the money come from.